Hello, I'm Michael Sullivan, Chief Economist at Moonfare. We've just published a really important Moonfare white paper, the title of which is Cycles, Shocks and Diversification, where we look at the performance of private assets like PE through financial crisis of the last 25 years, through the business cycle, and also examine in great detail the diversification benefits and properties of private assets. Let me give you a little bit more detail on what we've done, and it's an important piece of work because there's a relatively few papers on the performance of private assets compared to all the work that's been done in public markets. First of all, we've looked at the long-term returns from private equity, from venture, risk adjusted, and then also compared to public markets. And we confirmed the findings of many other reports that since about 2000, private assets, PE in particular, outperforms public markets. Volatility is lower. It would be, of course, because private assets are less subject to the vagaries of financial markets. We also find intuitively that there are fewer drawdowns or big drops in private assets like PE through time, so they have less of a damaging or negative event impact on portfolios. One of the really interesting things I think we've done is to examine how these assets perform through the business cycle, through recovery, expansion, slowdown, and the contraction phases of the business cycle. And in a way, the results are quite intuitive. Private equity, for example, is quite cyclical, quite sensitive to the business cycle. It tends to outperform public markets as the economy slows. It's a little bit slower to pick up, but when the expansion phase of the business cycle kicks in, which I think where we're beginning to get to in the world economy at the moment, then PE outperforms public market equities, certainly outperforms bonds as well. So the solid upswing in the business cycle is a really positive time to be into private assets. Then we've also, to put things in context, we've looked at the performance of PE and other private assets in the context of a portfolio, because we know all of our clients hold equities, hold bonds, they hold other asset classes. In particular, family office will hold maybe even direct investments. And we've looked at a couple of very, very simple rules of thumb. We've taken a very simple 60-40 equity bond portfolio. We've added in 20% private equity, so effectively you get 50, 30, 20. And the addition of private equity gives you either a slightly higher return for the same level of risk, or it actually improves the overall risk return quotient or coefficient of the portfolio. And that's the same is true if we look at other portfolio constructs. We've taken a typical European family office portfolio, which has got a slightly higher proportion of private equity, and again the diversification benefits of private equity are very, very clear. So the conclusions of the report, we've taken a very long time series. We look at the performance of private assets like PE. It's historically very, very strong. Risk is lower. We look at how private assets perform in financial market crisis, and they do relatively well. The really interesting work is looking at how private assets perform during the waves, the stages of the business cycle, expansion, recovery, slowdown, etc. You really want to have private assets when we're into the expansion phase of the business cycle. And then in a portfolio setting, we know our clients work with portfolios, they hold other asset classes. It's very, very clear that private equity and other private assets have a strong diversification effect in an equity bond portfolio context. The full report, 20 or so pages, is on the Moonfare website, and of course we've mailed it to all of our clients.